Hello everyone, welcome to Mom and the Children Financial Literacy channel. In this video, we'll be discussing a big lie behind the money. Look courage to become rich. How? Before we get started to today's topic, I want to answer two questions brought up by my children that will help us understand how banks operate. The first question is, why does a bank charge a fee to keep my money in their pocket? Their logic is that when I borrow money from the bank, I pay them an interest. But when my money is in their pocket, they are borrowing from me. Why do I have to pay them a fee? Before answering this question, we needed to know banks are for-profit institutions, so they need to make money, and their goal is to maximize their profit for their investors and the shareholders. Secondly, like any other business, they need the money to cover their operational costs. They need people to run their business, which will need them to pay salaries too. They need to pay rent, utility, and other fees like insurance for their physical branches. When you call the bank for a question or a service, someone on the other end of the phone helps you solve your issue. That is their employee to provide the customer service. When our bank mobile apps does not get created without IT support. With the digital money becoming more and more popular, banks need to invest the money in technologies like the banking platforms, mobile apps, and even cybersecurity. When you see any type of advertisement, it is paid by the business owner to make others know their products or service. It's called marketing or advertisement. Banks are the same. They spend money in marketing to attract customers. In addition, by charging a fee, banks can leverage their end of a bargain to incentivize certain behaviors. For example, maintain a minimum balance, provide a continuous direct deposit, which we will discuss next. So that comes to the next question they ask me. Why do you say banks can waive that fee then? So to answer that question, I ask another one. Can money produce money? If you can provide a direct deposit every month or maintain a minimum balance in your bank account, the banks usually waive your fee because they can use that money flowed into your account to make money. And those money can be used to cover their costs and other financial needs. A primary source of a revenue for bank is through lending money. Deposit from customers are used by banks to make these loans, and the minimum balance requirements ensure a consistent pool of funds for this purpose. When customers fail to meet the minimum requirement, like the minimum balance requirement or direct deposit requirements, banks charge a fee to add to their revenue stream. Banks need to maintain a certain level of liquidity and meet regulatory requirements. It's called the reserve ratio, which we can discuss in future videos. Minimum balance requirements contribute to this by ensuring a stable base of deposit. And direct deposit create a stronger relationships between banks and their customers. Once customers set up direct deposit and other services like automatic bill payment, they are less likely to switch banks. This relationship creates opportunity for banks to offer additional profitable products and services like credit cards, mortgage, and the loans. So basically, you will need to meet a certain bank's requirement, like minimum balance or direct deposit, to waive your fees. Those requirements are strategies that allow banks to manage their operational costs, generate revenue, attract and retain customers. To measure our personal financial health, we needed to understand the deficit and the surplus, which refers to the relationship between income and the expenses over a specific period of time. Our banking account, or we may simply call it our piggy bank, is like this bucket. Each month, if more money flows into this bucket than the amount of money flows out, we are in a budget surplus. This also means we have money left over after covering all our expenditures. On the other hand, budget deficit occurs if less money flows into this bucket than it flows out. Simply said, we spend more than we earn. Then basically, we are in a deficit, not enough money to cover our expenditures. I always hear people telling me you need to look rich to become rich. Is that a true statement or it is a lie? When you put our money inflow and outflow into that context, the statement seems to be suspicious. Maybe we can revise it after our analysis. Here's an example. If our income of this month is $3,000, but we only spent $2,000, we're financially in a budget surplus, then yes, we are richer this month. But if we spend $4,000 when our income is still $3,000, there's a gap between my income and my expenditure. We need to find additional $1,000 to cover this gap. Then we're financially in debt this month. That means we're in budget deficit. When in deficit, are we still rich? Maybe not. Maybe it is a lie. And how can we revise it? Because most of the time, merchants makes us look rich, can actually make us become poor in our banking account. So the first statement I revise it to is we look rich to become poor. Or maybe there's a second statement that we can think of. Remember, money is always in balance. So my second statement says we look rich to make someone else rich. Because when I buy merchants making me look rich, my money goes to the seller's pocket, making the seller rich for real. My expenditure is someone else's revenue. My debt is someone else's asset on their balance sheet. Money imbalance rule. The idea I want to tell my audience, my children, my younger friend is that we do not have to look rich to become rich. Financially, rich can be quantified through the difference between money inflow and outflow. But in our real life, it is a perception. Rich has a lot of a definition that is irrelevant to what we look like, especially in the eyes of other people. When in a deficit financial situation, and banks are charging outrageous interest from the credit card balance due to the money inflow and outflow gaps that we cannot meet, we surely don't feel rich. This makes me think about another statement. Fake it until you make it. But in reality, can you really make it in the end through faking it? I would say 99.9999% of the people fail to make it in the end through faking it. So we need to know when and how to pull ourselves away from commercial marketing that tells us false ideas, even lies. Thank you for watching my video. Let's grow together and become financially smarter and smarter. I'll see you in my next one.